Lesson 1, Part 4, Behavioural Finance. Within financial decision making, there are two different opposing views. On the one hand then, we have the traditional view that markets should always act efficiently, that a share price at any given time reflects all of the available information that's out there in the public domain. That it's not possible then to consistently outperform the market, even if you're a professional investor. And we also assume then that investors are rational and they make their decisions logically based on the information then that's available. But observation of the real world says that this doesn't always happen. If you look at a share price, you can see then that its movement can be extremely volatile. 1 minute it can be shooting up, another minute it can be dropping down. Also, if you look at the stock market, you can see that they might have very high periods of growth or very significant declines. And if we try and chart the movement of these stock prices, of these stock markets, to events in the news, they won't always match up. They won't always follow good news about a company or bad news about a company. They won't always reflect changes in the economy. So behavioural finance then has come about to try and use some of the tools of psychology to explain then how people that work in the financial sector behave. Behavioural finance then has looked at a number of assumptions that rational financial decision makers have used when acting for both investors and financial managers. They've looked then at the assumption that really what they're looking to try and do is maximise their utility. And when we talk about utility, we mean the value of their portfolio of shares and investments or the value of the company. That they're making decisions then based on all of the information that they have available to them there at the time. That they're making rational decisions that are backed up by evidence, that are objective, that they don't have any bias when it comes to risk. They're not a risk seeker. They're not risk adverse. They're purely risk neutral. So we might find some scenarios then in the exam when we're asked to help with some financial decision making. One of those examples could be advising on which shares an investor should buy, or another scenario might be where we're advising a financial manager on how much they should offer for the acquisition of another company. Now, in both of those scenarios, we would assume then that the investor or the financial manager is acting rationally. But there are a number of concepts of behavioural finance that would make us question this rationality. The first of these then is herd behaviour. The idea then that investors and people in the market then tend to follow the herd and mimic what other people are doing, especially the majority there. So what you might find then, if some investors decide to dramatically sell off banking stocks, then everyone else that holds banking stocks decides to sell them off. The opposite might happen, where the market rallies and increases because everyone is buying the same kind of stocks. People then are very much anchored to perhaps a specific piece of information there or a specific reference. They don't consider then the wider information that's available. They might simply see a share price going up and think, right, that's a great time to buy. They might see a share price going down and simply think that's a great time to sell, without really understanding what's causing that. Emotions then can tend to become very involved here in decision making. So investors then will get influenced by extreme emotions here, such as excitement or anger. We find then that they tend to overreact, that they can become very caught up in the moment there, that they can't sit back and look at the facts rationally. They also then tend to follow confirmation bias. This is then where an investor would tend to focus on something that really reinforces what they already believe. They're unwilling then to accept perhaps new information that would contradict what they already think. So they might be unwilling to sell a stock even if there is new information that paints that company in a bad light. Investors tend to be overconfident. They assume then that they can always have the ability here to pick the correct stocks and shares. They'll always believe then that past events were totally predictable, especially when they make a profit from it there. That actually, in real life, things are very random and based on luck. Finally then, they'll follow the gambler's fallacy. They'll assume then that because something has happened in the past, it's a good prediction then of what's going to happen in the future. So, for example, if a stock has gone up for 1 week straight, they must assume then that it must go down next. So they'll look to perhaps sell before that is the case. There are a number of limitations, though, to behavioural finance. We've seen then that perhaps investors could be irrational when they act by themselves. They'll act more as human beings there and make the mistakes of human beings. But when they're sitting there in a wider market there and active in a financial market there, that will provide them then with the discipline to act rationally and give them then the opportunities there to learn from their mistakes. We'll find then that the irrational decisions are very much made in the short term. And actually then over the longer term, the traditional theories, such as we discussed earlier, such as the efficient market hypothesis here, can be applied.